The Fed just killed its own rate cut plan in Kevin Warsh's first meeting. 9 out of 18 officials now see a hike before December, not an easing cycle. Friday, June 19, 2026. Like and subscribe for daily market updates. Today's agenda: Wall Street goes dark, where markets stand, the Warsh Pivot, the Iran turn, metals and crypto bleed, SpaceX rewrites the record, into the long weekend. Up next, where markets stand. It is Juneteenth and Wall Street is dark. The New York Stock Exchange and the Nasdaq are both closed today for the federal holiday, and the U.S. bond market is shut too. Trading resumes Monday, June 22nd. So today is about reading the tape that is still live, and the story underneath this quiet Friday is loud. On Wednesday, the Federal Reserve held interest rates steady, but it was Kevin Warsh's first meeting as chair, and he used it to flip the script. The Fed's own projections, the so-called dot plot, no longer point to a rate cut this year. They now point to a possible rate increase. 9 of 18 officials penciled in at least one hike before December, and a handful see two. The committee also stripped out the language that had signaled a bias toward easing. Markets had spent months betting on cheaper money, and in one afternoon that bet got harder to defend. Stocks actually recovered Thursday, with the Nasdaq up almost 2%, but the deeper message has not changed. This Fed is more worried about inflation than about growth. My call for today: the rate cut crowd is still too optimistic, and the first real test comes when summer inflation data lands. I would not fight this Fed yet. Back to the heart of it, because the central bank set the weather for everything else today. Where do markets actually stand heading into the long weekend? Use Thursday's closing levels as your anchor, because nothing in U.S. stocks has printed since. The S&P 500 finished around 7,500, up about 1% on the day. The Nasdaq did better, up nearly 2%, closing near 26,500, led by technology and chip makers. The Dow barely moved, up a fraction. The small-cap Russell 2000 was the real winner, up more than 2%, helped by a small dip in Treasury yields. Gold sits near $4,200 an ounce, pressured this week, even though it usually loves uncertainty, because a more aggressive Fed lifts the dollar and hurts metals that pay no interest. Oil tells the opposite story. West Texas crude and Brent both tumbled, with Brent down roughly 10% on the week to about $79 a barrel. Bitcoin has slipped below $63,000. The dollar index is firm, sitting at a 13-month high. Added up and the mood is mixed, not panic. Stocks resilient, oil collapsing, crypto soft, gold heavy. My read: this is a market rotating, not breaking. The dollar's strength is the thread tying it all together. The geopolitical story this month has been oil and Iran, and finally it turned for the better. Back to the heart of it, because the central bank set the weather for everything else. The Fed left its benchmark rate in a range of 3.5% to 3.75%, where it has sat since December. The vote to hold was unanimous, 12-0. What changed was the outlook. Officials now see inflation, measured by the Fed's preferred gauge, ending the year near 3.6%, a sharp jump from the 2.7% they expected in March. They trimmed their growth forecast to about 2.2%, and nudged their unemployment view slightly lower. In plain English, prices are stickier than they hoped, partly because of this year's energy shock, and they are willing to keep money expensive to fight it. Warsh, notably, declined to submit his own rate forecast, a quiet signal he wants to overhaul how the Fed communicates, and he announced review task forces to do exactly that by year-end. For Europe, the read-through matters. In favor of higher rates Fed and a strong dollar pile pressure on the euro, and complicate the European Central Bank's path, just as the Bank of England weighs its next move. My verdict on inflation and growth: inflation is winning the argument right now, growth is cooling but not cracking, and that keeps rate cuts off the table well into the autumn. That brings us to metals and crypto bleed. The global political story this month has been oil and Iran, and this week it finally turned. The United States and Iran have signed an interim agreement that ends the conflict that began in late February and, crucially, reopens the Strait of Hormuz, the channel through which a fifth of the world's oil moves. U.S. Central Command lifted restrictions on traffic to and from Iranian ports. Tankers that had been stranded began moving again, and Kuwait said it would lift production. That is why oil has collapsed back to roughly where it started the year, erasing a war premium that at its peak pushed Brent above $140. Vice President J.D. Vance says a 60-day clock has now started to settle the harder details, including Iran's nuclear program. So the risk is not gone, it has changed shape. For the United States, cheaper crude means relief at the pump and softer headline inflation. For Europe, which imports far more of its energy, the relief is even bigger. though Germany has already halved its growth forecast for the year to just 0.5%, blaming the war and the blockade. My call: the easy part of this oil move is done. The next leg depends entirely on whether those 60 days hold. With no live earnings on a closed market, let's revisit the corporate story that just rewrote record books. Now the hard assets and the digital ones. Gold has had a punishing week, sliding toward $4,200 despite all the global political drama, because the stronger dollar and the prospect of higher for longer rates make a metal that pays nothing less attractive. Silver has tracked it lower. Oil we have covered, down hard, with West Texas crude well below its recent highs and Brent near $79. The bigger drama is in crypto. Bitcoin has dropped below $63,000 in thin holiday trading, giving back the bounce it enjoyed earlier in the week on the Iran deal. It is now sitting right on its 200-week average, near 62,000, a level that has marked bottoms in past cycles. Ethereum is soft too, hovering in the low 1,700s. The driver is the same in favor of higher rates Fed. When safe cash pays more, speculative assets bleed first. On the flow side, the spot Bitcoin funds have seen money leaving rather than arriving, and analysts describe positioning as defensive and thin. Some warn a break below 60,000 could open the door toward 45,000, while others note that past dips to this long-term average have been buying opportunities. My read on investor mood: this is cautious panic selling, not euphoria. If 62,000 holds through the weekend, the bulls live to fight Monday. If it snaps, brace for more. So where does that leave us into this long weekend, with stocks firm but ground shifting under them? With no live earnings or deals printing on a closed US market, the corporate story worth revisiting is the one that just rewrote the record books. A week ago, SpaceX completed the largest public offering in history, raising about $75 billion by selling more than 550 million shares at $135 each. That is more than double Saudi Aramco's debut back in 2019. The stock, trading on the Nasdaq, jumped 19% on its first day to close near $161, valuing the company above $2 trillion and making Elon Musk on paper the world's first trillionaire. Why does a closed market Friday still care? Because that listing is a thermometer for risk appetite, and it ran hot, with record retail demand on trading apps. It also cracked open a frozen IPO pipeline. AI heavyweights have reportedly filed confidentially to follow. The tension now is obvious. In favor of higher rates, Fed raises the cost of exactly the long-duration, high-growth bets that drove SpaceX's reception. For European exchanges, watching megacap listings flow to New York is its own quiet worry about where capital wants to live. My call: the IPO window is open, but Warsh just made it narrower than it looked last Friday. Finally, let's turn into the long weekend. So where does that leave us into the long weekend? The mood is resilient but wary. Stocks closed the week firm, yet the ground shifted under them when the Fed traded its rate cut signal for a rate hike warning. The single biggest risk to this trend is simple: that summer inflation data confirms Warsh's fear and forces the market to price a genuine hike, which would hit tech, crypto, and gold together. The single biggest opportunity is the mirror image: that the collapse in oil, with Brent down near $79 and Hormuz reopened, feeds through to cooler inflation and hands the Fed room to soften its tone. The next 72 hours hinge less on data, since the US is shut today, and more on whether Bitcoin's 62,000 floor holds over a thin weekend, and whether the Iran ceasefire survives its first stress test. The real trigger sits Monday at the open and beyond, into the next inflation print. Here is my anchor call out loud: the market is underestimating this Fed, and I think the rate cut bets unwind before they pay off. Trade the dollar's strength, respect the oil move, and do not chase crypto here. If this kind of plain-spoken market read helps, subscribe and we will see you Monday. The market is underestimating this Fed, and I think the rate cut bets unwind before they pay off. The dollar's strength ties everything together right now. Stocks are resilient, but tech faces pressure from higher yields. Oil prices collapsing, which should help inflation cool eventually. Crypto soft as investors flee risk for safe cash paying more interest. Thanks for watching Market Pulse Daily.